Imagine this. It's 2007. The world is buzzing with excitement and anticipation. The world is introduced to a revolutionary device, the iPhone. Steve Jobs stands on stage, unveiling a gadget that promises to change the way we communicate, work, and play. People are lining up to get their hands on this technological marvel. The excitement is palpable, with long queues forming outside Apple stores worldwide. Now imagine taking that same money you were about to spend on an iPhone and investing it in Apple stock instead. It's a tough choice, right? A shiny new gadget or a piece of a company that's on the brink of something big. Would you be sitting on a gold mine today? The stock market can be unpredictable, but sometimes the rewards are beyond imagination. That's the question we're going to explore. What if you had chosen to invest in Apple stock back then? How different would your financial landscape look now? We'll journey back to 2007 and 2020, comparing the cost of buying an iPhone with the potential gains of investing that money in Apple stock. It's a fascinating comparison that reveals the power of smart financial decisions. Buckle up, because the results might surprise you. This isn't just a story about Apple. It's a lesson in the potential of investing. This isn't just about Apple. It's about understanding the power of investing and how it can transform your financial future. Let's dive in. Whether you're a seasoned investor or just starting out, the insights from this comparison could change the way you think about money and investments forever. The year 2007 marked a turning point in the tech industry. Steve Jobs, in his signature black turtleneck, unveiled the first iPhone. It was sleek, innovative, and promised to change the way we communicate. The price tag? A cool $499 for the 4GB model and $599 for the 8GB version. People eagerly emptied their wallets, eager to be part of the technological revolution. Little did they know that a different kind of revolution was brewing in the stock market. While consumers were fixated on the latest gadget, savvy investors were eyeing Apple's stock, which was poised for significant growth. In 2007, Apple's stock price hovered around $15 per share, adjusted for stock splits. Let's say you chose to invest that $500, the approximate price of an iPhone, in Apple stock instead. You would have secured roughly 33 shares of the company that was about to reshape the entire tech landscape. At the time, this might have seemed like a less exciting choice compared to owning the revolutionary new iPhone. However, as we fast forward through the years, you'll see how this decision would have played out in the long run. Section 4, 2020. The iPhone's evolution and Apple's soaring stock. Fast forward to 2020, the iPhone has gone through numerous iterations, each more advanced than the last. The iPhone 11 Pro Max, released in 2020, carried a price tag of around $1,100. Meanwhile, Apple's stock price had skyrocketed. By 2020, Apple's stock was trading at around $134 per share, adjusted for splits. If you held on to those 33 shares you purchased in 2007, your initial $500 investment would have grown to over $4,400. That's nearly a 9-fold increase. Section 5. Apple stock, post-2020, continued growth and market dominance. The story doesn't end in 2020. Apple continued to dominate the tech market, with its stock reflecting this success. Even amidst global uncertainties, Apple's stock price has shown remarkable resilience. By November 2023, Apple's stock price reached new heights, hovering around $190 per share. Those 33 shares you hypothetically purchased in 2007 would be worth over $6,200. This illustrates the power of long-term investing and how a company's growth can translate into substantial financial gains. Section 6, 2020, iPhone purchase versus Apple stock, a stark contrast. Let's rewind to 2020 and imagine you were faced with the same choice. Buy the latest iPhone 11 Pro Max for $1,100 or invest that money in Apple stock. The iPhone 11 Pro Max was the pinnacle of technology at the time, boasting an impressive camera system, a powerful A13 Bionic chip, and a sleek design that turned heads. It was the must-have gadget of the year, and many were eager to get their hands on it. However, if you had opted for the stock instead, you would have acquired approximately 8 shares at the then price of $134 per share. Investing in Apple stock might not have given you the immediate gratification of owning the latest tech, but it represented a stake in a company known for its innovation and market dominance. Each share was a piece of a larger puzzle, a bet on the future success of Apple. Fast forward to November 2023, those 8 shares would be worth approximately $1,520. This increase reflects Apple's continued growth and success in the market, driven by new product launches, expanding services, and a loyal customer base. The value of your investment would have grown significantly, providing a tangible return on your initial decision to invest in the company's stock. While this might seem less impressive compared to the 2007 scenario, it still outperforms the depreciating value of the iPhone 11 Pro Max, which would likely be worth a fraction of its original price in the used market. The iPhone, though still functional and perhaps cherished, would have lost much of its monetary value, reflecting the rapid pace of technological advancement and consumer demand for the latest models. In contrast, the stock investment would have appreciated, highlighting the potential long-term benefits of investing in a company's growth over time. Section 7. The long game, patience, and the power of compounding. These scenarios highlight a crucial financial lesson: the power of long-term investing. It's not just about putting your money into stocks and hoping for the best. It's about understanding the principles that drive growth over time. While buying the latest iPhone might offer immediate gratification, the joy is often short-lived. The value of the phone depreciates quickly, and soon, a newer model will be out, making your current one feel outdated. On the other hand, investing in a company like Apple can lead to significant long-term wealth. Imagine if you had invested in Apple a decade ago. The returns would be substantial, far outweighing the cost of any iPhone. Of course, investing in the stock market carries risks. The market can be volatile, with prices going up and down unpredictably. It's essential to be prepared for these fluctuations and not panic during downturns. Stock prices fluctuate, and there are no guarantees of profit. However, history has shown that the market tends to rise over the long term, rewarding patient investors. However, by investing in companies with strong fundamentals, such as solid financial health, competitive advantages, and capable management, and holding on to those investments for the long haul, you give your investments the best chance to grow. Patience is key here. It's about staying the course even when the market is turbulent. You harness the power of compounding, which is the process where your investment earnings generate their own earnings. Over time, this can lead to exponential growth, allowing your money to potentially grow exponentially over time. Think of it like planting a tree. It starts small, but with time and care, it grows into something much larger. Remember, investing should be a well-thought-out strategy, not a get-rich-quick scheme. It's about making informed decisions and being patient. Before making any investment decisions, take the time to educate yourself. Read financial reports, study market trends, and understand the companies you're investing in. It's crucial to do your research, understand the risks involved, and be aware that not all investments will be successful. Diversifying your portfolio can help manage these risks. And consider your own financial goals and risk tolerance. Everyone's financial situation is different, so tailor your investment strategy to fit your personal needs and long-term objectives.